There are 6 critical things you need to know if you're an investor, whether you're a beginner and have just started investing, or whether you've been investing for a few years. Without understanding these, you are not going to be making the most of your investments, nor growing them as fast as you could be. So make sure you're sitting comfortably. Let's go. Number 1, investing and trading is different. If you are buying today with the hopes of selling at a higher price tomorrow, then I wish you luck and I hope you know what you're doing. Whether you do or you don't, this is not investing. This is trading. Now, trading isn't bad. I do it myself on foreign exchange from time to time, but it's important to understand what it isn't. It isn't investing. Investing is for the long term. Trading is for the short term. This video is about investing. This means you are buying something and intending to hold on to it from anything from a few years to a few decades. I invest in things which I believe will grow over the long term. Any profits or dividends are added to the overall pot and then reinvested to grow, and grow. Number 2, you might ask, what is the reason for investing at all? Well, in a way, it goes back to number 1. The purpose of investing is to build wealth over the long term. Keeping money as cash in your wallet, in your purse, in a safe or under your mattress or even in a bank account does nothing. It just sits there as cash and hardly grows at all. In a current account, or in the US you might call this a checking account, your money, if it's sitting in there, hardly grows at all because hardly any current accounts pay any interest at all. In a savings account, the interest rate you'll be getting on that should be better, so your money might be growing a little bit. However, this will be very small compared to earnings through investments. Let me highlight this in a simple example. Let's say you keep cash in a savings account, a good savings account, with a 4% interest rate. £1,000 put into this savings account will return £1,217 after 5 years. That's a 5-year return of 21.6%. Now let's say your £1,000 was invested into the Vanguard FTSE Global All Cap Index Fund. Not the best return and not the worst, but over a 5-year period, this would return you £1,677. That's a 5-year return of 67.7%. So cash in a savings account, that £1,000 turned it into 1,217. That same £1,000 invested into an index fund bought you 1,677, over 40% more. That's just one example why investing is better over the long term. Number 3. You don't need a lot to start investing, but you do need something. There are so many different discount brokerages these days, such as Trading 212 or Free Trade, so you don't need to be paying a commission to buy shares or funds, depending on what broker you are using and what you are buying. Just choose a zero commission discount broker, the one that doesn't require a minimum account balance, and off you go. On top of this, even those shares that have a high share price, say AstraZeneca PLC for example, which is trading around £122 per share at the moment. If you had just £100 to invest, with some of these brokers you can invest in that stock as well, because some of these brokers let you buy fractional shares of companies. So you can still buy part of that stock and benefit from a share of dividends and any share price growth that you see. And remember, it's not just about the stock market. That is only one type of market that you can invest in. By investing in the stock market, you are effectively investing in businesses and the growth in profitability of those businesses over time. But you could also invest in property. If you wanted to invest in property, say a property that costs £600,000, then one way to do it is to save up for a deposit, say 25% of the value of the property, then buy it, rent it out, and then generate an income from the rental yields. But these days, you don't need to do that any longer. If you don't have 25% of that property value to invest, you can do it with a much lesser amount through fractional property investment sites. Something like London House Exchange, where you can invest for as little as £50. I've left a link to London House Exchange in the description below if you want to check it out. You could then own a share and again take part in the rental yield that that property generates and any growth in the value of that property. Then there's digital currencies as well, or cryptocurrencies. I speculate in this space, but I struggle to call it investing for now. Though I'm convinced digital currencies and blockchain in particular are here to stay, who the winners will be amongst all the thousands of different projects is anyone's guess. I'd gladly buy into a diversified crypto or blockchain index fund if there was one today. That would be investing for me. We all have tax-free allowances every year. Miss it or don't use it and you lose it. Why anyone would choose to invest, make a profit, see a value growth in their investment, and then choose to pay tax on that profit or gain is beyond me. You should always maximize your tax-free options. Do all your investing through an ISA as a minimum. That means all growth, all income, all returns through those investments will forever be tax-free. Nothing else changes. It's kind of like changing the wrapper on a chocolate bar. If you have a chocolate and you put a wrapper around it, the the chocolate inside doesn't change. It stays exactly the same. That's what an ISA is to your investments. It's just a tax wrapper that you put around it. The investments inside don't change, but that wrapper ensures that you don't pay any tax on any growth, any income, any returns that those investments ever make. And it's important to understand that ISAs come in many forms. There's the non-investing type of ISA, the cash ISA. But for investments, the two that you need to know about are the stock and shares ISA and the innovative finance ISA. Think about it like this. The stock and shares ISA is for investments in the stock market or similar instruments. So shares, bonds, mutual funds, ETFs. Innovative finance ISAs, on the other hand, are for other markets, such as property, peer-to-peer lending, or others. Innovative finance ISAs can provide exposure to different types of investment markets and potentially higher returns, but that does typically come with a higher level of risk as well. And whilst to some degree, risk applies to all types of investment products, those types of investments you can do through innovative finance ISAs are considered higher risk still, with limited protections in place should the platform or company that you're using default. Number 5, start early, learn and grow. There's only one way you can learn the game of investing, and that's to get stuck in. Compounding works great the longer you're in the game, but learning works the same way, right? Compounding isn't just for money. Compounding pretty much works for anything that you stick long enough at. The longer you've been doing something, the more you know about it. I know about investing because I've been doing it for over 25 years. Property, stock market, gold, Bitcoin, foreign exchange, angel investing, investing in VC startup funds. I play a role in all of these areas, and the amount I know about each has exponentially grown. Or in other words, it has compounded, just like my money. I couldn't have learned so much just reading books and watching videos. Number 6, timing the market is stupid. Did you hear me? I said it's stupid. It's stupid. No one is able to time the market with any degree of accuracy. Not hedge funds, not professional traders, and certainly not you and I, who are trying to invest in our pajamas through an app or something. We might get it right from time to time, but that's not because of our genius. Even a clock that has run out of batteries has the right time twice a day, but it's wrong the rest of the time. And if you try and time the market, you might get the odd fluke here and there, but most of the time you'll get it wrong. If you really want to know why timing doesn't work, then JP Morgan did a study about that, on how timing the market destroys your growth, and you'll want to watch that video next.